How does the ring network alter the strategic equation? No fleet is big enough to occupy 1,300 systems. So you don't try to hold the territory, you hold the choke point. You just need to be able to lock the door.
You just need to be able to lock the door. Wow. What a beautiful strategy. In Season 5 of The Expanse, Martian Admiral Sauveterre is lecturing cadets at the War College. He's secretly recruiting for a breakaway faction that will eventually become Laconia. He's trying to teach them that the discovery of the ring space, the hub that connects all the star systems, fundamentally changed warfare itself. His key insight? Asymmetric control. Whoever controls the ring space controls the universe. It is an unavoidable toll booth for interstellar civilization. Now, throw out the starships. Let's talk global capital. Most people who pick individual stocks invest like the old Martian Navy. They look for current value, they look for future growth. They argue about PE ratios, cash flow, and other metrics of profitability. In short, they try to occupy economically valuable territory. They buy Apple because they like iPhones. They buy Exxon because they like oil. They buy Nvidia or Google because they think AI is the future. They are betting on individual planets in the economic galaxy. But what if we adopt Admiral Sauveterre's strategy? What if we don't care which company wins? What if we only want to own the ring space of the financial universe? The choke points that all money must inevitably pass through. My Miller Momentum strategy, which I use in my retirement account, focuses on riding the flow of capital. I think this is the best strategy for index-style investing. When picking individual stocks, however, I prefer to focus on taxing the flow of capital rather than riding it. Here's a portfolio that does exactly that. I call it the Laconian portfolio. This portfolio isn't diversified in the traditional sense. It's 100% all in on financial infrastructure. The 8 companies I've invested in are the Gatekeepers, the Mapmakers, the Volatility hubs, and the fixers of global capital. Let's get into it. First, you have the Gatekeepers. 45% of my Laconian portfolio. FICO at 15%, Moody's at 15%, and S&P Global at 15% are the ultimate choke points of debt. Think about it. If you want to buy a house, you must pass through FICO's algorithm. If you are a corporation or even a sovereign nation and you want to borrow $1 billion by issuing bonds, you must pass through Moody's or S&P to get a rating. If they don't rate you, you don't exist to major investors. They don't lend the money, they just control who gets to borrow it. They can lock the door. Next, you have the Mapmakers. We have MSCI at 15% and S&P Global again. These companies create the indices that the world invests in. When you buy an S&P 500 index fund or an emerging markets ETF, trillions of dollars of passive income are blindly following the maps these two companies draw. If MSCI decides a country is no longer investable, billions of dollars exit that country overnight. That is superpower level control over the flow of money. Then you have the volatility hubs. You have CBOE at 10%, the Chicago Board Options Exchange. If you want to trade options on the S&P 500, or if you want to hedge against volatility using the VIX, your trade goes through their servers. They own the marketplace for the trade of volatility and fear. And Virtu Financial, VIRT, at 10%. They are a massive market maker. They provide liquidity. When markets go crazy and everyone is panic selling, Virtu is the firm on the other side of the trade, taking a tiny slice of every transaction. They don't care if the market goes up or down. as long as it moves through their pipes. And finally, you have the fixers. Houlihan Lokey at 10% and PJT Partners at 10%. These aren't your average banks. These are elite specialists you call when giant companies merge, or more importantly, when they go bankrupt and need to restructure billions in debt. When the economic giants are crashing into each other, these are the guys who manage the debris field and profit from the scrap they salvage. This Laconian strategy doesn't care if tech is beating energy. It doesn't care about inflation or deflation. Because whether the economy is booming or crashing, companies still need credit ratings. People still need FICO scores. ETFs still need to track indices, and traders still need to hedge volatility. Like Admiral Sauveterre in the ring space, this portfolio just sits in the middle, controlling the flow and collecting a toll on every single transaction in the financial universe. So for my individual stock portfolio, it's not about picking winners. It's about owning the whole battlefield and supplying both sides of the opposing armies that fight over it. And if you don't want to own individual stocks, that's fine too, because it's even possible to implement a bit of a broader take on this Laconian strategy by owning 60% IAI, 20% GPZ, and 20% DBMF. By owning all US broker dealers and securities exchanges, all alternative asset managers and private equity, and dipping into macroeconomic trends and capital flow, one can also effectively control the choke points of the global economy with a less concentrated bet. Like many things in investing, there's multiple ways to execute a strategy successfully. So, let's look at the back tests, shall we? Alright, so I've got my Laconian strategy pulled up with my individual stock picks, as discussed in the video thus far. I've got the Laconian portfolio alternative, which uses only ETFs, and because GPZ doesn't go back that far, in fact only about half a year, I've got the Laconian portfolio backtest pulled up, where I've taken the top positions in GPZ and weighted them appropriately to create a synthetic GPZ for backtesting. So let's see how closely things are aligned. So you can see that the Laconian portfolio and the Laconian portfolio backtest are very nearly identical with each other, which is exactly what we want to see. Let's set it to where we're contributing $2,400 quarterly for these portfolios. And in full disclosure, you can see that my individual stock picking strategy is not doing very well this year, but that is perfectly okay because the 8 stocks that I've picked are having a very bad year, and that means that it, in my opinion, is a very good time for me to buy them. So, anyway, let's get started with that back test. So we hit our back test button, we glide down, and you can see right here that the concentrated strategy on just those 8 stocks has performed very well over the past decade, with volatility and max drawdown comparable to the S&P 500. But look at those returns. That's exactly what we would expect to see if we have captured control of the choke point, because we will not only enjoy the returns of the market, but we will enjoy the returns of the market plus the fees collected on transactions and flow of the market. And you can see this even on the Laconian portfolio backtest version with the synthetic ETF for GPZ. It doesn't look nearly as high as the concentrated strategy, but compare that to the S&P 500 itself. So just take SPY, 100%. Look at that. It's still easily beating the S&P 500 and definitely beating the global stock market because it's essentially taking the stock market's returns, but then layering on top of that the fees that are collected from the transactions. What do you think of the Laconian portfolio? Is it a brilliant strategy or too concentrated for your taste? Let me know in the comments below. And as always, don't forget to like and subscribe. Let's get rolling with Miller Momentum.